What's one sector that you are most excited about in 2025?
Technology.
Consumer electronics.
Struggling to keep up? Welcome to the FOMO Fix. 2025 is just around the corner, and as investors, you're probably wondering whether this is a year of opportunities or should we play it safe. With so many events happening globally, it's essential for us to stay informed of the key trends that could potentially shape the markets. I'm Hazelle from the Joyful Investors, your navigator on this journey to financial empowerment. And joining me today, we've invited Geoff, Howie, and Nigel. Guys, say hi to the audience.
Hi, I'm Geoff Howie. I'm a Singapore Exchange market strategist. I've had the pleasure of having that role for the last 13 years, Hazelle. And I think my first investment was in university. As an Australian, it would have been a mining stock. I don't think the company exists anymore.
Hi, my name is Nigel. I'm a final year student studying in the Singapore Institute of Management. I study finance and economics, and the first time investing for me was about 3 to 4 years ago. So I was invested in banks and the technology sector, and I think that's worked out pretty well for me ever since.
Right. So really great to have both of you joining me today in this episode. Maybe we can start off by first looking at the big picture first. So Geoff, could you share with us what are the most important global trends that our audience, investors like Nigel as well, should be keeping an eye on in 2025?
Goodness, that could be a really long answer.
Oh.
Could take the whole hour, but let's try and do it. Okay, so I guess the most important thing is we are taking a very cautiously optimistic outlook going into 2025. So the most important thing is we expect stable growth, moderating inflation, as well as these, I guess, global developments that really are providing more of the upside risks for 2025 and downside risks for 2025 as well, particularly when it comes to interest rates across the world. And that is a key issue, along with geopolitics, along with potential slowdown in China, and of course, whether interest rates do change or whether they bottom out a little bit higher than we thought they were, that will impact a lot of sectors. That's very much an overarching trend going into next year. There's also things like climate, environmental risks, as well as great developments happening on the digitalization front, particularly in AI-enabled machines. This whole PC recycle that's going through at the moment is providing a little bit of uplift going into 2025. But I think taking all those parts together, the best thing for Singapore and investors is that this second half, the economic momentum has been much stronger than in the first half. So that obviously bodes well for 2025.
Right, a lot of insights to get from you. I heard that you talk about the interest rates, right? So interest rates, we know that is a very key tool that the central bank used to control the level of inflation. So back then we had high inflation, and that's why the US Federal Reserve started on the rate hike cycle back in March 2022. And since then, we have seen that inflation has been rather more or less in control because by raising the rates that will curb the consumer spending, the borrowings, and thereby ease the inflationary pressures. So, and as we look ahead, in fact, as we speak right now, we have already seen 2 rate cuts. One of 50 basis point and another 25 basis point. And back in September, the Fed also released a dot plot, which indicated that likely by the end of 2025, the interest rates will be somewhere between 3.25% to 3.5%. So Geoff, on this, what are your thoughts about the inflation trends, the changes in interest rates in 2025? Could there be any possibility of a deviation from the dot plot that we see, right, released back in September with inflation reigniting again?
Possibly. I wouldn't say reigniting, but you could have a little bit of a turn upwards before your ultimate goal is reached. And what's the ultimate goal? That was always the Fed Reserve wishing its PCE core deflator would move to 2%. We did a lot of financial modeling going into this year, 2024, and it showed that 2024, the outlook for that PCE core deflator would actually bottom out at 2.5%, not 2%. And that's important for us because banks make up 30 cents in the dollar that changes hands in our stock market every day here. REITs make up another 10 to 15 cents in the dollar. So as I said, the interest rates in the US are very overarching. Now, What's changed, I guess, since September is the election of Donald Trump, the 2.0 Trump administration. And with that new election, the consensus outlook for interest rate cuts next year is for rates to be less dovish, or we're looking at 50 basis points less of rate cuts, because Donald Trump would like to come in with a number of initiatives, such as reducing the corporate tax rate in the US from 21% to 15% by FY26. There's also tariffs, and tariffs, the whole point of the tariffs is it's not to produce inflation, but it's to shift more costs back upstream, particularly back over to those countries that are involved more in the manufacturing part of the value chains of those products that make their way to the US. Third thing, the regulation, particularly cutting of red tape in key industries like tech, finance, and energy. And because of that, you've got a more buoyant outlook for the US. So that means rates potentially coming down less, and that's more supportive for the US dollar. So if the US dollar is going to be higher, we could be importing more inflation here in Singapore, because we are an island, we import a lot.
Yes.
We spend a large amount of, maybe at least 30 cents on every dollar here is spent directly on imports. So what it means for us in Singapore is, I would say the budget in February 2025 will be somewhat still similar to February 2024, in that the government will be looking to alleviate cost of living pressures. So they might look to extend support in those for households in those areas of essential services, public transport, healthcare, education, and so forth. Because that, if you look at the domestic risk that in terms of where we are at the economy, it's a very strong year this year. It's the increase of cost of living and cost for businesses that could provide some downside risk next year. And there's multiple ways to deal with that. It doesn't just have to be from monetary policy statements. We've seen a very proactive government here in reducing and alleviating as many of the costs that come with regular life as possible.
Right. So today we have with us Nigel as well, who is a retail investor, right? So
I'm sorry, taking all your answers.
no. So as a retail investor, how does inflation rate changes or interest rate changes affect your investment decisions, or have you actually shifted or modified your portfolio accordingly to changes in interest rates?
That's a really good question. So as a young investor, right, I think usually the main concern for students investing as well is that we look towards more sustainable and, in a way, a more safe option to invest, right? So I think that interest rates is definitely something that we look at as someone who is really, because usually for students, right, we don't really have large capital to invest in. Therefore, it's not very viable for us to take like a lot of risk when we invest. So we do look at things like interest rates. We do look at things like geopolitical tensions, like what Geoff has mentioned, when we do our investment, because we're actually looking to hold our investment for a very long period of time instead of really doing things like trading or like short-term investments. Yeah, so I think that this does have a really huge impact on whether or not we decide to invest in a particular company or invest in a particular industry.
Right. So in that regard, right, if let's say the interest rates were to remain elevated for a longer period of time due to inflation, right? So which sectors, Geoff, do you see that likely it could face the greatest challenges or headwinds in?
Well, firstly, banks benefit from higher interest rates, okay? That's the most important thing, in that about 2/3 of their income, particularly our three here, DBS, OCBC, and UOB, is generated from net interest income and net interest margins. So the higher the interest rates, the higher the net interest margins. And that's why, for I think it's about 8 consecutive quarters, the trio have reported combined $8 billion net interest income every quarter for the last 8 quarters or so. But there's also the non-interest income component that's also doing really well on all the dynamic stock market moves, and investors also asking those same questions, which has benefited their wealth management business. Real estate investment trusts are generally touted as one that is very rate sensitive. The higher the rates, the higher the financing costs.
Yes.
And we've seen some initiatives to alleviate some of the pressure that it has generated on the real estate investment trust through making some tweaks to the interest coverage ratio. So just basically giving the REITs a little bit more leeway for
more
borrowing.
room.
But they already have borrowing rates that on average are quite a bit less than the threshold limits and so forth. But if you really want to take that broad holistic view and say, okay, this one is less sensitive, it's going to be those sectors that are more paralleling the big structural economic drivers of Singapore and Southeast Asia. So an element of industrial sector, utilities, resources, and energy typically could be less sensitive to where rates are going. That by that, they're structural drivers, so they're less sensitive or less elastic to the cyclical drivers, which are typically driven by the cost of money and interest rates. So
I see.
That's
Right.
That's
So
the
you
answer.
mentioned about the real estate investment trust. Actually, before
Yeah.
that, we actually had one entire episode covering about REITs, actually.
Who was
and
that with?
That was with Kenny.
Oh, brilliant. Yeah, our go-to.
And yes, we understand that REITs generally, they are more interest rate sensitive.
Yeah,
So
but also tech, consumer electronics, and so forth. So we
Yeah.
thought the global trade revival this year and the manufacturing recovery led by technology would be a lot earlier this year. But that's also because we were also thinking the Fed would start cutting rates in March, not September, and thus that has been delayed. So as I said, it is overarching and does impact a lot. You know, the basic costs of your operating your business in terms of finance costs does have that overarching impact on most sectors that have that high element of cyclicality.
Right. But I also believe that generally the interest rates, they move more like in a cycle, right? Just like the economy moves in a cycle, we're not going to be in the expansionary phase forever. Eventually, the growth will slow down, sink into a recession, but neither are we going to be in a recession forever. And it's going to start going back up. So same thing, interest rates, they can't be held for too long, too high for too long. Otherwise, it may strain the economy as well, right?
But some of our major trading partners will also want to hold for a little bit longer or as long as they can, because, for instance, Malaysia, BNM have their rates at 3%, RBI, India's at 6.5%. I think Thailand has made a 25 bips cut from 2.5, and Indonesia has also made, I think, a 25 bips cut, rates around 6%. So they want to keep them high as possible, because as the Fed cuts, that can help appreciate their currency and attract investment back into their countries, whether it's foreign direct investment or portfolio inflows, with the appreciation of the emerging Asia currency versus the US. So that's the thing that the rest of Asia, emerging Asia in particular, has not been in a rush to follow the US, because they also have the decent growth, obviously.
Right. So you mentioned a couple of sectors. Nigel, any of those sectors that you have been actually keeping an eye on or that interests you actually?
One particular sector that I'm really interested in is actually the technology sector.
Okay.
So aside from that, actually, I completely agree with Geoff. And when he mentioned talking about the three banks, OCBC, DBS, as well as UOB, I myself, I invest in those banks. Interest rate is something that is very broad, right? In a sense where it really affects like majority of sectors, and I think that in particular the ones that I'm interested in are the banking and mostly the technology.
I see, right. So really it's quite a difficult decision on the Fed, right, to whether to raise rates by how much, to cut rates by how much, because either ways there will be some repercussion and implication on the economy at large, right? So earlier on we talked about inflation. Now there's another topic that interests a lot of people as well, which is recession. So as we head into 2025, once again people are talking about whether there could be a recession in 2025. Actually, it's nothing new. Just like how we started 2024, people were also talking about whether there will be a recession in 2024. And we also saw that back in 2022, there was the inversion of the yield curve. And this year, there was the uninversion of the yield curve. So some people has been speculating that that could be an indicator that a recession may be coming soon. While, of course, there are others who say that the economy is far more complex than just a single indicator. So, Geoff, what are your thoughts about the possibility of a recession in 2025? And generally, how reliable is such an indicator?
This is for Singapore or globally? You're looking at?
Globally.
Globally,
Yes.
well, it's unlikely globally. When you look at growth projections, because always around this time of year, you've got IMF, World Bank, OECD, ADB, those four big institutions come out with their global growth projections for the next year. And I think emerging markets, emerging Asia's expected to grow around 5%. So that bodes well for us, okay? The thing is, when you're an investor, there's always some part of the world, some part of the stock market that's in recession. Our manufacturing last year, for instance, our trade, it wasn't great, and for that reason, a lot of those segments and of stocks were also trading at, we like to say, discounts to long-term valuations. Okay, so that provides investing opportunities for value traders. Case in point is that, okay, looking forward next year, we expect consumer and tourism related stocks to continue their resilience and be a strong part of our economy, as well as finance, information and communications, and of course that recovery in trade and tech that I talked about. But the key thing is, not one size shoe fits all for all the stocks. Stocks can be quite asymmetric. You don't have a symmetrical move over your entire consumer stocks just because we've got a better outlook for consumer sector here in Singapore, because we're going to have more international arrivals.
That's true.
It depends on how much of that has been built into expectations of the stocks. So in fact, when you're looking at kind of cycles, recession and growth in the stock market, you do need some framework and context when it comes to investing, and looking at where the stock is valued now compared to where it was valued recently or the last 5 years can help investors to basically work out what the potential risk to reward is when they're making these decisions.
Yeah. Earlier on, you mentioned something that really resonated with me, which is that regardless, right, there's always something happening in the macroeconomy right there in any country, right? But regardless, what's important is whether the individual companies that we are investing in, right, how they are doing, the fundamentals, all this play a part as well, not just, whether there's a recession that's going to come. Yeah, so even like you mentioned, even if the outlook for the consumer is positive, optimistic, it doesn't mean to say every single stock are going to do well or are going to do badly and so on. So at the end of the day, that is a broad environment, but also how the individual company manages under such an environment is very key. So as a young investor, Nigel, yourself, how do you perceive the talk of a recession? Does it concern you, or you see that as a chance for certain investment opportunities?
I guess I'm thinking, like, as an investor, how do I get the opportunity to enter the market during a recession? I think that's my biggest concern as an investor.
Does it concern you because of the crashing prices?
Yeah, because
so you are more fearful of going in. Is that a concern?
I think for a beginner investor or anyone starting investment itself, right?
Yes.
Like when you start, you are usually concerned about whether the market is in your favor or not. And I think that when you enter the market during a recession, it can be quite scary as a beginner investor.
True, emotionally.
Correct. Because investing, if you don't really get a grip on emotions, you can be quite, it could be really quite difficult. So I think investing during a recession could be difficult for someone who hasn't really started investing at all. But I think that in terms of opportunity, you see a really good amount of companies actually benefiting post-COVID. So one of the companies during the COVID period that actually was really beneficial, their operations was SIAS. So I was looking at SIAS, right, as a company, and actually their operations during COVID was so amazing in a way that they actually pivoted, being a company that relies heavily on airlines, right, and aviation catering. And they actually pivoted the operations more towards like commercial food catering, and that actually helped to ease their business through COVID. And you see a lot of companies actually doing this, trying to pivot their operations so that they manage to sort of tie through this difficult period. And I think that this is maybe something that investors such as myself can look at, companies that have a game plan in mind to get through things like recession.
Right. I think you mentioned a very important concern at the start, which is how do I manage my emotions and being able to take that first step out to buy more stocks during a recession, right? When the prices are crashing by 30%, 50% or more. That's definitely one key area that investors got to look at as well. So really, it's not just about strategy, but also the emotional part of as an investor, the psychology is also another area that we need to manage, because actually oftentimes market crashes are really great opportunities, isn't it, for us to accumulate the good companies at even cheaper prices. Yeah. But the irony is when it comes to investing, people are fearful. But when we do our everyday shopping purchases, that's what exactly we like to do. We like to go for sales promotion and start buying more during such times, right? So emotionally, it can be hard, but I guess that's something that the mindset part is where we have to actually build up on for investor to be able to identify opportunities regardless of whether it's a bull market right now or whether it's a bear market, right? So in bad times, you can get to buy stocks, good companies at good prices. During the good times, you will see a portfolio going up, right? You see the returns that's expanding in our portfolio. So it is the mindset of how we can actually construct that, right?
Yeah, and I think that's a really interesting point you said about how we go to the shopping market every week. We that's consistency in our shopping behavior, our consumer behavior, and that consistency, I think, should be applied in investing as well. We don't go shopping now for everything that we need over the next 2 years.
Yes, we don't do that.
Because prices can change. And it's exactly the same with investing. As you said, it was pretty tough in COVID, and you think, okay, markets crashed 20%, I'm going to go all in now. And then it crashes another 20%. And then you're thinking, okay, it's a horrible feeling.
Yes.
So one thing that our broker community and remisers for that matter have been very strong in supporting is for investors that are a little bit concerned about timing risk and buying at going lump sum at the top of the market, and then basically having a big market risk that actually does come to fruition. Yeah, the drawdown is dollar cost averaging. So it's not without its risks, obviously, dollar cost averaging. But you think of it this way. If you've got your stock, Nigel, that you're covering and it's trading at $1 now, and you think, okay, do I put $10,000 into that now, or why don't I just buy $100 worth of the stock at the end of every month for the next how many years? That's going to that's going to help you. So think of it this way: it's $100. The stock's trading at $1. You're buying 100 shares of the stock at the end of the month. The stock price crashes from $1 to 50 cents. You can buy 200. What if the stock rallies from $1 to $2? $100 is now only buying 50 shares. So you're buying half as much.
Yep.
Even through COVID, if investors applied this methodology to the STI, the STI ETF, from the end of 2019 right through to the end of November 2024, your compound annual growth rate was actually between 6.5% and 7%.
That's pretty good.
But a lot of that came from a lot of that volatility in 2020. You see a lot more buying of units when the prices were a lot lower.
Yep.
And you're seeing a lot less buying. Your $100 or $1,000 gets less units at these highs. So this is a really important aspect when it comes to investing. I think it's consistency, and also having an ecosystem of brokers and bankers and remisers who recognise that and want to work with you to come up with some solutions.
So on top of consistency and also discipline in applying a strategy throughout, any other ways in which the investor can position their portfolio in the event if, let's say, a recession materializes? So how can they actually position their portfolio?
Geopolitically, tensions, gold is the go-to as well. So the World Gold Council recommend that even in the less geopolitical tense times, this is 10 years ago, they were suggesting that investors have 2 to 10% of their portfolio in gold. Because if it's high inflationary, if it's driven by supply chain disruptions from wars and so forth, then gold can obviously help potentially alleviate that based on past returns. Obviously, that important caveat: past returns don't guarantee what happens in the future. But also, I think, if I can personalize it a little bit, you will have recessions. in your
Eventually.
working career. You will have ups and downs, and you will too. I've had it. We've all had it. But I think, and I was so delighted to hear that you are invested in our banks, because your degree right now is in finance. Read those annual reports. Read those transcripts of the analysts' briefings. Follow these companies. Look at their risk committees. Structure your life in a way that you want to be on the board of one of those banks in 20 years. You can do that. All that material, all the kind of important corporate themes that boards have to be aware of and acknowledge, and risks they need to mitigate. It's all transparently laid out in those annual reports and those interactions that analysts have with the management of the companies. You can study up, do your homework now, and I do think all young investors should, regardless of what industry sector you want to work in, go and find out who the industry leaders are, the listed industry leaders. Buy their stock, not necessarily to make an investment or a return, but make an investment in yourself and follow those industry leaders. Work out so that come 20 years time, you can be an expert on how how these companies have navigated all the macro and micro challenges of the past 20 years.
Right. You mentioned about gold. On top of gold, consumer staples, would that also be another sector, I'll say, that investors can also consider, right?
It can be, but this also has its own risks, because climate risk, remember, is also geopolitical risk, and climate and environmental risk is also on the radar going into next year. So you just have to be wary that, for instance, in India, a lot of their CPI comes from food, particularly potatoes, onions, and tomatoes. And if you have some adverse weather effects, that can that can impact inflation. It can impact the cost and make it tough for those businesses. I mean, sometimes the prices can rise and the businesses can do well. So I can understand what you're saying, but I think there's enough kind of drivers that can cause the recession that investors are able to be a little bit more precise, as you say. Could be consumer staples, but you can't. It's not relevant. It's not necessarily the same for every single type of food and agriculture market that's available there. But it definitely is explorable.
Right. So we talk a lot about inflation and recession. Earlier on at the start, you also talk about geopolitical tensions. Now let's dive deeper into this topic on geopolitical tensions. So Geoff, how do you see these geopolitical tensions affecting global investments in 2025?
The tariffs that could come with the Trump 2.0 administration can have an impact. They have a mindset that at the moment, there's too many countries that have too many trade surpluses to the US, and they're going to look to even and balance that up a bit. So it's not just China, but as an example, how did the tariffs impact China investments? And the following year, once the tariffs were implemented, the US dollar appreciated 5% to the renminbi. So if you're a US dollar investor, based investor, or let's say Sing dollar based investor, and you're investing in China, you've already got a negative 5% currency translation risk just on the back of the tariffs alone. Yes. And you also had the US dollar appreciate another 1.5% the following year. So there's definitely an impact. And the tariffs also, if they're pushing more costs back upstream to the manufacturers and the testing and the handlers of the products that are going to the US, that can impact productivity and impact employment. It does have an impact. I think protectionist policies and tariffs is one particular risk next year that we will be watching on the geopolitical front. It's not also to take away from the tensions in the Middle East and Eastern Europe.
Right. So for Nigeria yourself, do you also keep an eye on all those geopolitical tensions? Does it concern you?
Yeah, I think that geopolitical tensions is something that really affects any investor's portfolio. Personally, for myself, I invest in China, and I think that during that period of time, wow, you can really see the effect of geopolitical tensions on that particular country, So I think it's definitely something that you should pay attention to. I think that it's super important that you keep your eye out for things like, example, tensions between countries like China and the US, and wars happening around the globe. So I think that these kind of events can help you to not only be aware of the things that are happening to the investments that you make, but as well as any opportunities to enter the market. So like what Geoff has mentioned, you want to enter the market at a premium, right? So things like this doesn't necessarily have to be a bad thing.
Right. So with all of that we have discussed so far, Geoff, could you point out to us 3 practical actions for young investors who are preparing themselves for 2025? Any learning tips or resources that they can look at as well?
You want to get into a pattern of investing. Moving from a saver to an investor is not necessarily easy, and therefore education, as we know, is really important. So I think you've got to be really sure on what your objectives are. Do you want long-term growth?
Yep.
Do you want some extra supplemental cash flow to help pay for vacations and living life? And then once you know that, you can understand and look at what type of market. Then you look at what type of frequency and consistency you will apply. Will you look into not go all lump sum, but will you look to kind of, as we said, dollar cost over the quarters, over the months, over the years? You got to tailor make your way, and it's got to be all built around your own risk profile. There's choices there. There's a lot of options there, but you've got to be comfortable with what you're investing and the frequency, most importantly, because otherwise it won't be sustainable.
Yep.
Right. And as we talk so far, right, we haven't actually heard from Nigel. What are your plans for 2025? Any idea on how you're going to position your portfolio or investment strategy for 2025?
I think for myself, the EV market is something that I am personally pretty interested in. I think that it has a lot of potential. I think that the technology sector right now is booming. You can see a lot of growth from technologies, industries in the US right now. You can see that the performance towards the end of the year has been pretty different from the start. It's quite a big jump. There's a big gap. So I think that going into 2025, maybe I would be paying more attention to the tech sector. I think that there's a lot of opportunities in that sector, and it would be good to look at and invest in.
I see, right. So maybe we can move into a very short Q&A segment, right, for Geoff, right? Because I think, Nigel, probably you have some burning questions on your mind as well. So maybe I can start the ball rolling first. Recently, China has been a rather hot topic that people are looking at, especially with the rollout of the SDRs for some of the China stocks. But even before that, if we look at the China-focused ETFs that we have here in Singapore, generally, they're also the ones that are facing a higher trading volume as well. So one of the more highly traded ETFs. On China, we know that the problem that they're facing is the property market slump. They have the weak consumer demand, right? So, Geoff, do you see this as a risk, China as a risk that's worth taking in 2025? Or should investors tread more cautiously in China?
I think time in the China market's important. There's a number of structural drivers that are at work at the moment. And yes, the property market is really important, but there's also a plan to fix it. But it might not see, the plan is long-term structural. So you might not have recovery of property market in 2025. In fact, I think it's highly unlikely.
Yes.
I think most consensus is the end of 2026 or maybe early 2027 at the most. There's still quite a bit of work to be done on completing housing projects. The housing price mechanism is still quite rigid. And obviously the non-viable developers are being kind of put aside. The viable developers are being put into the center of the frame. And also the fiscal framework with the local governments is also works in progress, but significant work has been done on that front in 2024, particularly with the ultra long bonds and so to speak. So there's good things happening there. The other segments of the market, like the capital markets, have also seen significant reforms this year. Wu Qing, the insider, took over the CSRC in February. Under his leadership, there's been a lot of unveiling of capital market measures to really boost vibrancy. We've got a new benchmark rate for interest rates in China this year. It's been a lot accomplished there. And you know what? Maybe the nature of the economy and the way it translates into our stock market, in that the 10 best performers in the STI make up 70% of the weight. And the 10 least performers of the STI this year make up only 13% of the weight. So you can see the way it's worked. But the best performer is actually based in Jiangsu in China. It's a shipbuilder called Yangzijiang Shipbuilding. It's been our strongest STI stock this year. It was also our strongest STI stock back in 2022, 2021, even 2017. And it has been building ships that are more green in their fueling. So I think their order book, which should be around $20 billion now, it's its all-time highs, their order book. A lot of that now is into more sustainable solutions for shipping, more fuel-efficient ships. And the stock also, what's interesting is it has its costs mostly in renminbi, and it sells most of its ships in US dollar. So the US dollar appreciation to the renminbi has actually worked in favor for this stock as well. And it's also been expanding its capacity and its ability to build ships. So this one is interesting because when you look at China, you might not realize we have a number of stocks here in Singapore that report more than half their revenue to China or base more than half their assets to China. And these are not just Chinese companies. These are also Singaporean companies that have really over the time built their businesses around the Chinese industrial and consumer sectors.
Yeah, right. So when you want to have exposure to China, it doesn't necessarily only have to be the China companies, but even some other companies that have a huge, say, concentration of their revenue or their supplier side to China, that will also give you some exposure to eventually the growth in China as well, right?
Yeah, exactly.
Right. Any burning questions on your mind, Nigel?
I'm really interested to know what is your thoughts on how effective the stimulus package is for China. Like the government's trying to inject money into China to stimulate the economy, right? How effective do you think this is in sort of alleviating whatever issues they have in the economy right now?
You know, I've studied China quite closely for more than 30 years. A sinologist is the Aussie term for it, but I think it will be effective. But the issue is the reforms in the stimulus, Nigel, that they put to work, it has multi-year objectives. So if you're a short-term trader and you're looking for that strong delta or that big reaction to a policy initiative, you have to be cognizant that you will have an initial reaction because it's usually so big,
right?
In terms of trillions and trillions of renminbi. However, the objectives aren't for the next month, not for the next quarter, not even for this year. It might be through to next year or the year after. So you have to be cognizant. It's different, and it's a really great question because there's a lot you can delve into if you want to look at the effectiveness of the structural reforms. And you got to remember, when you're looking at stimulus, there's three ways to do it. There's monetary, there's fiscal, and there's, we say industrial, but it's also structural or strategic. And they're the reforms that I think are really important. Sometimes not so easy to get a breakdown in terms of what impact it will have on the ABC and the XYZ stocks. So what you can do is International Monetary Fund, for one, has a lot of working papers that has a lot of focus on China and a lot of kind of sectorial industry type of reports that are obviously independent and not generated from China's state media and can be quite useful in assessing what impact the reforms will carry into growth and development. And I think that's a really great resource that you should be looking at. I mean, I was looking at it when I was your age for my thesis, right? I had to kind of see what these organisations were saying on economic development. But yeah, IMF working papers. There's one every working day of the year released. So this is a wealth of information there. Like you can see, like we've got Tianjin Johnson Darren Tang Pharmaceutical, which has been listed here in Singapore. It's listed in US dollars, but it's been on the right side of the reforms in traditional Chinese medicine. On the reforms over the last 3-4 years to really clamp down on counterfeit TCMs and only have the regulated legitimate ones. This stock's been a beneficiary of that. So it's about finding what the reforms are, what the objectives are, when the outcome is expected to be delivered, and then also finding your stocks that are relevant to what I think is really important.
My second question is, when you look at a recession, in your opinion, which sectors get hit the hardest and why?
Well, it depends on a country perspective. If you're looking here at home, it's manufacturing trade because we are so highly trade dependent. I mean, we're dependent on a number of things, but as a small island economy, everyone likes to say that, the total amount of trade that comes through comes through Singapore, is 3 times the GDP. And the reason they're saying that is because we do a lot of re-exporting,
Right.
Particularly in machinery, industrial machinery and petrochemicals. Digitalization is one area that we are really super strong at in terms of digital exports, like financial and business services. If there was a G7 existed in the world of digitalization exports, we'd just be outside it because we rank 8th highest in the globe according to the WTO. So I think the areas are where we punch well above our weight. That was also, has all the great strengths, brings all the great resilience, but it also means that's where we can be vulnerable as well due to the multiplier impacts, particularly in trade and manufacturing. So that has a particularly strong impact, as we've seen in the last few years. This revision of our growth projection for this year has been really on the back of the manufacturing recovery we've seen since the middle of the year.
Right. Before we wrap up this conversation today, Geoff, what would be one last final piece of advice or insight that you would like to share with the young investors as they look ahead to 2025?
I think if you're interested in the stocks, really follow our stock market more. There's something every day happening that's of interest. It has to be, right? You have 500 stocks that are trading. Sure, the majority of liquidity is in only the top 100, but we also have new products coming along. We have these 13 Singapore depository receipts, one of which is Delta Electronics Thailand, which really fits with what you're talking about in terms of power infrastructure, mobility solutions in EVs and so forth. That's also been Southeast Asia's strongest tech play since the end of 2019. Its returns are pretty much on par with NVIDIA up to as of now. But the street all at the moment believe it's had its course, and they're all basically either underweight or sell on it. So that's interesting too, right? The fact it's so high, the streets thinks it's had its run. Who knows? We have to see. It means that at the moment it's priced in a way that you just never know what can happen, and therefore do follow what it reports every quarter.
Right. A huge thanks to Geoff and Nigel for joining me today in this conversation. And thank you all for tuning in to this episode. As we look ahead to 2025, these big trends aren't just headlines. They are your guide to staying ahead in the markets. Until next time, keep your FOMO in check, stay informed, and happy investing. See you guys again in the next episode of the FOMO Fix. Thank
Thanks,
you.
Hazel. Thank you so
All right,
much.
thank
Nigel.
you.
Very
Thank you so much.
If you're feeling fired up and ready to dive deeper, feel free to hit us up. Leave your comments below. We would love to hear your questions and topics that you would like us to cover in future episodes.